Hello everyone and welcome back to my new video. You are watching The Wealthy Brains and now let's get in this video. Stablecoins are cryptocurrencies that are just often expressed in dollars. Thanks to these dollar index coins, you have the opportunity to maximize your chances of protection from market fluctuations or risks. Let's quickly look at some popular stablecoins. Tether, exchanges, Binance, OKX, Huobi, and many more. Market cap $1,884,587,370. True USD, exchange, Binance, DigiFinex, BitZ. Market cap $213,749,697. MakerDAO, exchange, HitBDC, Qcoin, Oasis DEX. Market cap $56,801,526. Paxos Standards, exchange, DigiFinex, OKX, Binance. Market cap $167,241,364. Gemini Dollar, exchange, HitBDC, BCEX, DigiFinex. Market cap $86,072,734. Stablecoin is nothing but a fancy name for one of the two assets that have existed for decades: electronic money or shares in money market funds. And both can only be stable with government support, either through regulation and supervision or through bailouts. To paint stablecoins as a product of private ingenuity that is superior to a public option for digital money fails to consider the recent history of monetary and financial crises. The basic idea behind stablecoins is simple. You find someone willing to receive your dollars in exchange for something more exciting. An asset that is issued digitally may work to make some payments and can also earn you some interest in the meantime. More than that, the receiver of your dollars promises you that it stands ready to exchange the stablecoins back to dollars on a 1-by-1 ratio basis anytime you want. No losses, hassle-free. Sounds great, right? But there's a catch. The promise can only work if the stablecoin issuer properly manages the reserves, which are the dollars it received from all the people buying the stablecoins. Imagine that you pay me $100 for some coins I've just launched, say 100 Samba coins. You can use the Samba coins to stream newly released Brazilian music, and if you don't spend them, I'll exchange the Samba coins back to dollars at once. What should I do with $100 to avoid breaking the promise of exchanging the Samba coins back to dollars at any time? I could keep the $100 in cash at a safe place or deposit it in the checking account. If the Samba coin is successful and I start having more buyers, I could invest the dollars in short-term treasuries, trusting that not all buyers will come to exchange the Samba coins back to dollars at the same time. Because treasury bonds are typically stable in value and liquid, I could earn some small return and quickly sell the treasuries to meet payments when people wanted to sell me back their Samba coins. So far, so good. What if I'm feeling bold and want to make higher returns from the Samba coin reserves? I could invest the reserve dollars in the other crypto assets and use them on a decentralized finance lending platform to earn eye-popping gains. All good, unless I start having trouble to get out of these investments and convert them back into dollars. Situation that will leave my Samba coin reserves depleted. At this point, I'll not be able to buy back your 100 Samba coins for $100. Maybe I can give you $20 right away, and with luck, $20 more next week. That's also the moment when you'll probably start urging the government to step in and regulate stablecoin issuers, especially those using algorithms to keep the coin stable. What are the lessons here? First, no money substitute can mimic the stability of cash, either dollar bills as they exist today or digital dollars as they'll exist in the future. Cash may not come with bells and whistles, but when issued by a credible central bank, its value is stable over time, meeting the need of those who prefer safety to profit. That's why stablecoins can only be truly stable if they are 100% backed by, you got it, cash. Second, government support in the form of regulation and supervision is crucial for the success of privately issued stablecoins. Just look at the regulated stablecoins that already exist and have a prominent name outside the United States. Electronic money in the United States, because no federal statute regulating e-money exists, stablecoin issuers are subject to state money transmitter laws and may end up regulated by 50 different regulators. The problem is that rules and regulations about segregation of clients' funds and integrity of assets kept in reserve aren't uniform or consistently enforced. How do stablecoins affect cryptocurrency prices? Cryptocurrencies are not affiliated with any government or firm. They're also not bound by political, social, and other economic indicators. These currencies, which depend entirely on supply and demand in the market, can therefore be quite volatile. This volatility is both a driver and a result of the lack of public trust in cryptocurrency as a reliable and balanced currency option. Poor and undefined regulation also play a role in adding to this distrust. People are disconcerted by the lack of structured framework to guide adoption of crypto and therefore view it as a speculative investment. Sadly, half of the world's wealth now is in the hands of the 1% of the population. The situation in the world of cryptocurrencies is not much different. 20% of all bitcoins are owned by 448 people. These people, called whales, play an active role in influencing the prices of cryptocurrencies. If these people want to convert their crypto assets into stablecoins, the price of cryptocurrencies enters a downward trend, or vice versa. How do stablecoins work? Stablecoin is a cryptocurrency with a fixed value. This means that the value of the cryptocurrency should not fluctuate frequently as in normal crypto assets. Although this fixed price range is often tied to the US dollar, there are also currencies fixed to different price indices. Some stablecoins, which are just getting ready to enter the market, aim to be fixed to be the consumer price index or similar indices of some countries. The decisive factor for stablecoins is how the latch is maintained and what the whole system is based on. In other words, how does the coin organizer maintain the value of the currency? Some central stablecoins, such as Tether, require a custodian to regulate the currency and then reserve a certain amount of collateral. Tether holds the US dollar in a bank account, and the amount held must be equal to what they issue to maintain the order of the system. In this way, price fluctuations are prevented. However, there are other stable decentralized cryptocurrencies such as DAI that achieve this goal without a central authority figure. They use smart contracts on the Ethereum blockchain to manage the collateral and maintain order. Are stablecoins worth considering? If you don't know much about blockchain technology and you don't know what to do with changes in market conditions, you may need to keep your digital assets in stablecoins since cryptocurrencies are quite often volatile. The volatility in cryptocurrencies is sometimes so high that if you don't trade correctly, you may lose a lot. If you cannot keep a close eye on market conditions or changes, or if you are simply not familiar with all of these, it may be wise to keep your digital assets in stablecoins. In addition to this, cryptocurrencies can enter a recession period called bearish, in which the value of all coins falls considerably. During these periods, you can avoid potential risks by converting your digital assets into stablecoins. But at the same time, if you have been working as a trader in the market for a long time, then stablecoins may not be for you at all. This is because traders follow daily fluctuations in cryptocurrencies, arbitrage, usage graphs, and many other ancillary data to generate revenue from price increase or decrease of cryptocurrencies. Hence, traders usually stay away from stablecoins. In the following section, I have listed some advantages and disadvantages of stablecoins. Stablecoin advantages: benefits of crypto economy, low fees, secure transactions, somewhat or completely anonymous, stable, asset-backed, aids in adoption, acceptable or easier bridge from fiat to cryptocurrency use, regulations, fiat-related regulatory processes involved. Stablecoin disadvantages: requires third party, requires trust from an entity, external audits needed to ensure assets are accounted for, less return on investment, traders and investors typically desire higher returns and may resort to other means for financial gains, regulations, fight involving processes involved. Final thoughts. Although stablecoins seem to be a safe escape point by many, the damage to cryptocurrencies also needs to be considered. This is because, especially when large whales move down the market, they can secure a significant blow to the price of cryptocurrencies while securing themselves to stablecoin. Therefore, we cannot say that there is a definite consensus on the existence of stablecoins. I am one of those who think that stablecoins are an obstacle to rising prices of cryptocurrency. For small traders or investors, switching to stablecoin does not affect the market price. But the escape of large whales to stablecoin or their escape from stablecoin has the power to drive the entire market bullish or bearish. While respecting both opinions, it will be interesting to closely monitor the future of stablecoins. This is all for today, folks. If you enjoyed the video, then leave a like, and if you are new, then do not forget to subscribe. Stay tuned for the future updates. See you till the next video, and thank you for watching.